Good morning. Let's do it, my friends. Welcome to the Street's opening bell here from Post 35 on the floor of the NYSE. Today is Tuesday, the 15th of November. Remember the 15th of November. That's not what they say, but we have fun on the show. I'm your host, JD Durkin. Opening bell rung just moments, and I do mean moments ago, by Franklin Templeton. This to celebrate their 75th anniversary. We got big photos here of Dr. Ben Franklin, which of course is their logo. Congratulations to them. We also have members, men and women of the armed forces once again here on the floor of the NYSE. If you hear applauding, and rightfully so, it is in recognition of their sacrifices to this country. The major market index is giving back a bit of their gains from the big pop they had the week before. That's referencing yesterday's session. But stronger than expected retail numbers from Walmart helping give things a jolt this morning. But really top of mind at the moment is the deceleration in PPI. That's the price, or the producer price index. The October numbers out an hour ago show some optimism, or leading to some optimism here for investors as we kick off the session. Let's now take a look at what's on tap for this morning's show. We will, of course, talk those PPI figures. Inflation is the latest data that signals that inflation could finally, dare I say, maybe possibly be slowing down. Who knows? Plus a batch of retail earnings before the bell. We'll break down some of the biggest reports. And finally, we will bring you the latest, don't worry, folks, on the FTX fiasco as the embattled crypto exchange continues its downfall. Does it ever? For more on those stories and so much more, we now bring in our very own senior editor and chief markets correspondent, Mr. Martin Baccardax. Martin, I was kind of inspired by yesterday's show when we did the choose your own adventure portion where I allowed you to pick. So I'd be interested in starting with PPI because I think it's top of mind like right now. Are you cool if that's where we start with our line of questioning?
I think that's absolutely the way that we should go, JD. This number really is what's putting some rocket fuel into the market this morning. And it's rare for producer price inflation data to do that. It's a bit wonkier. It's not something that the Fed focuses on. And as a result, it's not something that the market might necessarily cling to in order to drive a rally. But what we are seeing is that it dovetails with the softer than expected inflation data that we saw last week at the consumer level. So to recap, at the producer level, what I like to call factory gate inflation, we saw prices rise 0.2% on the month. That was about half the street forecast, and about 8% on the year. And that was also south of the street forecast. And more importantly, JD, it's about 3 percentage points lower than the high watermark that we reached in March of this year. So decelerating factory gate prices, as well as the muted gains that we're seeing in consumer prices, really are aligning to suggest that broader inflationary pressures are easing across the board, and as a result are going to continue to decelerate into the end of the year and beyond. Now, whether or not PPI is something that the Fed is going to focus on specifically is kind of besides the point. The collective data, which is absolutely what we need to focus upon, is indicating to us that inflation dynamics have probably peaked. I would actually venture to say they absolutely have peaked. Slower readings going forward are going to change the Fed's perspective on near-term rate hikes and ultimately where it gets on the policy path, and that's why you're seeing stocks react today. Lower interest rate assumptions, higher stock prices.
I want to break this down for viewers who might be hearing these flurry of acronyms, Martin, last week and this week. CPI, PPI, Consumer Price Index, Producer Price Index. Break this down a little bit. Let's just briefly step back and help better define these terms for someone who might be a bit unfamiliar. And what is the relationship between the two? And do they always move in the same direction? I think is important context for someone to know.
They generally move in a broadly similar direction, JD, but the space between them is incredibly important. And I think you're right. It's worth looking again at exactly what we are talking about. When we talk about consumer price pressures, we're looking at the ways in which we measure price change for the things that we buy off the shelves: clothing, cars, food, accessories, things like that, as well as rent, as well as healthcare premiums, and all of the things that are typically part of a spending basket over a given month. For producer prices, we're looking at the input costs that businesses have to assume in order to make the products that we ultimately buy on the shelves. So you can see where I'm going with this point. The difference between producer price increases and consumer price increases are absolutely critical to understanding what kind of profit margin companies can expect without increasing prices. In other words, if they are seeing muted input cost increases, they can have wider profit margins if CPI stays the same. If those numbers narrow, you can see profit margins narrowing along the way. So very often the difference between PPI and CPI is a good barometer for us to understand how profitable companies are going to be going forward. In today's instance, however, JD, I think the bigger focus is likely on the fact that we are seeing that collective series of data from inflation either at the factory or at the consumer level declining, and that's more important than the margin impact that we would normally focus upon with respect to corporates and profitabilities and market performance.
And so obviously we're seeing a big reaction from investors this morning, as we knew we would based on the pre-market data. The S&P right now, as we speak, 7 minutes into the start of the session here, Martin, up 1.5%. The Dow is up 1.2%. Is the hope there for investors to say, hey, maybe inflation's starting to cool? What does that now mean for the central bank? We are just a couple of weeks away from their December deliberations. Pardon me.
Yes, ultimately, we're not seeing a great change in what the expectation is for December, but we are seeing incremental change. Right now, there's an 80% chance, based on the CME Group's FedWatch, of a 50 basis point rate hike. That's essentially what we saw yesterday, and probably won't change that much, but it will probably cement it, and I think ultimately that's important. We're also going to see probably pairing of bets on big rate hikes into next year, barring some unforeseen circumstance, and I really don't think we're going to get it. So stocks are now finding themselves in a situation, JD, where they can neutralize the political discussion, one of the big risks heading into the autumn. They can now have a better understanding of the inflation picture and therefore the Fed reaction function. That was the second major risk factor heading into the autumn, and can focus on corporate earnings. That's the third. Now, corporate earnings are okay this quarter. They're probably going to decelerate into the final months of the year, but we all understand that. I think now people are looking into what 2023 is going to deliver, and the big concerns they have are corporate profitability and economic growth, because the other two risks have been neutralized.
Aside from Jay Powell specifically, who is obviously the representative of the Fed we most frequently hear from and is probably the household name, more or less, to viewers, we do also hear from time to time, Martin, from other Fed leaders. For instance, today we will hear from the Philly Fed president, as well as the Fed governor and some others. How closely should investors or viewers of this program follow along with their comments for some additional signal of what might be to come?
I think always, JD, I really do. I think that Chairman Powell has been good at trying to have a collective voice for Federal Reserve rate decisions. I think the last one was a little bit different, where the statement that was agreed by the members of the Open Markets Committee, which decides interest rate policy, the statement was different from what Powell was saying to reporters afterwards. That's a relative rarity, and it might just speak to Powell's caution as opposed to a differing of opinion. But what we do look for when these Fed governors are out in the field is whether there's any deviation from the central path. And we aren't really seeing that, even though some of the comments can be cherry-picked to sort of, provide bullish or bearish sentiment to the market. I think in the main, investors need to pay attention to whether there's a great deviation from the preferred interest rate path, or indeed the preferred messaging that is supplied by Chairman Powell. Therefore, I think it's something that we obviously have to track closely. But those are the sort of, that derivation is what we should mostly pay attention to.
Martin, is there anything else top of mind for you with regards to PPI? I did not specifically ask you about that you wanted to address before we move on to earnings.
Only the fact, JD, that we spoke, I think, last week or perhaps the week before about that hidden component in China inflation, where we saw the first deceleration in producer price inflation in China in more than 2 years. And I thought that that was going to be an indication of softer inflation here in the United States as well, because, of course, so many input costs are exported by China into the global economy. Now, many people had said that the PPI readings in China were a result of a weak economy rather than a more efficient one, and they're probably right. But nonetheless, if China is going to start exporting deflation, in other words, if their exports going forward are going to be at lower prices than they were last year, that's going to be excellent news on not only factory gate inflation, but ultimately consumer price inflation as well. So that's more grist for the mill of those who say that inflation has peaked and we are on that downward trajectory.
Wall Street is waking up to a bit of welcome news from Walmart as the retailer reported a pretty solid quarter, all things considered. I do want to start with the angle of inflation and prices specifically. Martin, what was the impact there that we heard from Walmart?
Well, Walmart has always tried to say that they don't like to pass inflationary costs onto its consumers. They always want to make low prices a sort of the bedrock of their corporate branding and dynamic. And to be honest, I think they are actually truthful about that. There has only been minimal price increases in Walmart, and you can see that in evidence given the fact that actually their profit margins are narrowing whilst their sales are rising. So I think Walmart, I won't say that they're taking one for the team as such, but they are reluctant to pass on significant price increases because they know that shoppers come to it for value. So actually what we ended up seeing out of the quarterly earnings was really solid gains in comparable sales. In other words, the amount of traffic that US stores had this quarter compared to the one last year, a solid increase in revenues, which were over 152 billion US dollars. That is a staggering amount. It's about 70% more than Apple will generate in revenues in a given 3-month period. And they beat the street at the bottom line by about 10 cents per share. So all in all, it was a really solid number from Walmart, perhaps a bit surprising, but not necessarily reflective of them passing on inflation to consumers. It was more about operational efficiency. And I really do believe that is in part, at least, why the stock is doing well today.
Were there any additional tailwinds that worked to the company's benefit for the third quarter? And with an eye to the future, what did they say specifically about forecasts? Because that's certainly something that made more than a few headlines earlier today.
Yes, no question. Ultimately, they are looking at solid but not spectacular gains over the final 3 months of the year. Now, they could be conservative with that estimate, but ultimately they're saying that their same-store sales forecasts are going to be about 3% higher than the same period last year. That's a little bit south of street expectations, but still reasonably solid. So I do believe to some degree the tailwind is going to come from whether or not shoppers are going to be focused on value into the Christmas period, or whether they're going to extend their discretionary spending as a result of maybe boosted sentiment from the market or something similar. That's probably an unknown variable at this point, but Walmart is looking pretty good. They trimmed their forecast for earnings decline this year because they have a lot of cost to absorb from earlier in the year, and their inventory position is also improving. Lots of metrics underneath that are providing that tailwind today.
I do want to pivot to Home Depot and get your perspective on this, Martin. The company also posting strong quarterly earnings before the bell, continues to benefit from home improvement projects. That's been an interesting space the last several years, right? This idea of home improvement projects, big during the era of quarantine, maybe a bit of a pullback. A lot of these companies facing additional inventory, which has been part of the challenge. So they realize, like, oh, maybe people don't want to continue improving their homes at the pace that they did in the spring and summer of 2020. But what are some of the biggest takeaways that we learned from Home Depot's report, I wonder?
Well, I like the way that you led it, JD, because I think that Home Depot has something that a lot of companies would love to have, and that's a counter-cyclical aspect to the business. And by that, I mean when the housing market is turning down, people will then pivot and begin improving the homes that they have in the hopes of being able to sell them at the maximum profit, or indeed maybe even stay in them for a little bit longer. So I think that home development project is the reason why we had a significant increase in Home Depot revenues. We had improving profits as well. Both of those were welcomed by the street. And what I also noticed, JD, was that the average ticket price now at Home Depot is around $90 per person per visit. That's about 9% higher than it was this time last year. And it comes against the fact that actually they're seeing fewer transactions. So in other words, ticket prices were up 9%, but overall transactions were down 4.5%. That
We may have lost Martin's audio there for a second. Martin, we're going to do a quick little boop, boop, beep, beep, boop, audio reboot. Martin, you got me? Those are my R2-D2 sounds, by the way. Let me check in with my producers, folks. What's the latest on Martin? Folks, we have a technical difficulty slate. This is great. In my whole TV career, I've always wanted to toss one of these. We're going to toss this up. We're going to get Martin's audio back. We're going to be right back to talk about Home Depot. Stay here. Hey now, back like I forgot something with the great Martin Baccardax. So Martin, before we were, before we had to toss to a commercial break because we got to pay the bills. Before we had to take a brief reprieve, I just wanted people to refill their cups of coffee so they could be focused for the second part of our conversation. We were talking Home Depot, some big takeaways, and talking about some of the unique challenges or opportunities maybe that you feel like a company like Home Depot has for this quarter.
Yes, I'm not sure how far we got into the answer, JD, but it's probably worth repeating the fact that Home Depot really does have something that I think a lot of companies would love to have, and that's a counter-cyclical element to their business dynamic. In other words, when the housing market turns down, people will then begin to maybe increase the amount of home improvement projects they wish to undertake, either to boost the maximum value of their house in order to sell it, or maybe just to stay in it a little bit longer. So that was a big part of the drive in terms of both the revenue and the earnings gains for Home Depot. And ultimately as well, we saw that the average ticket price, in other words, the amount of money spent by each visitor for each trip, was up about 9% from last year to just under $90. Now, that came against the fact that actually transactions were down about 4.5%. So here is an example of Home Depot being able to pass on price increases, as evidenced by that difference between ticket prices and trips, and at the same time experiencing or capitalizing on that increase in home improvement projects. So I think the shares are up a little bit this morning, largely because they only held on to their end of year profit forecast. I think they're being conservative, and ultimately they probably will end up outperforming. But I did kind of find a little bit surprising the initial reaction to the earnings, which I thought was solid. And I think now the market is really just digging underneath the hood and pricing the stock up a bit. And probably it's catching a tailwind from the better than expected earnings from Walmart as well.
I'm glad you kind of looped in both companies into one response. My next question, more or less, was does Home Depot have the same opportunities or threats that a Walmart has in this environment, or is it a bit more unique? Help me better understand the comparison between the two.
I really feel they're quite different, JD, for the most part. Walmart can rely, its counter-cyclical buffer, I guess, if you will, is the grocery market. And they're, of course, increasing market share as a result. And that was a big precursor in why we are seeing such discussions about grocery store mergers going forward this year, Kroger and Albertson, and I would imagine some others as well. Walmart is stealing a lot of market share from value-focused customers. So that's its buttress. For Walmart, for Home Depot, the buttress is really more about these home improvement projects. The two companies are different with respect to inventories as well. Home Depot doesn't hold on to its to a great deal in the same respect as some others do, and therefore you do get the differential. Their forward-looking forecasts are, for the most part, predicated on consumer strength, but they do differ in terms of how they anticipate that strength will materialize.
Are economists overall expecting to see a weaker holiday quarter for all of the big box retailers? What do we know, at least in terms of expectations?
Well, I think it's horses for courses, really. I think their expectation is that consumer spending is going to weaken a little bit into the final months of the year. But the expectation is that it will be solid enough to probably drive at least operational profits for those that are executing with efficiency. In other words, it's not going to be the tide that lifts all boats that it has been in the past. And I wouldn't imagine that we're going to be seeing record-breaking spending over the Black Friday weekend either, simply because people are having to deal with this multi-year increase in inflation, a bit more insecurity in the job market, and the expectation of an economic downturn.
Any other big earnings you are looking forward to this week, Martin?
I mean, retail is the focus this week for sure. So we'll get Target and Lowe's tomorrow. I think we'll get Macy's, we'll get Kohl's, and we'll get TJX as well over the next 2 or 3 days. Those will all be interesting because, of course, they speak to different pockets of the U.S. retail space, some with more unique challenges than others. But nonetheless, it will give us a significantly broad barometer of consumer strength, not only into the October quarter, but heading into the final months of the year. And then, of course, the retail sales numbers on Thursday will always be interesting.
Electorally speaking, Martin, we do have at least one update since you and I spoke last. Trump-aligned Kari Lake losing the governor's race in Arizona to Secretary of State, the Democrat there in that state, Carrie Hobbs. We talk an awful lot about federal government pressures on markets, the things investors should pay attention to as it relates to Congress. But what is top of mind for you as it pertains to state level policies in a state like Arizona or anywhere else that might also be interesting for investors to closely track?
Quite honestly, JD, I don't think that there are. I mean, particularly in a state like Arizona, which really doesn't have a great contribution to the U.S. economic picture. I don't mean that in a derogatory way. It's just a small state that is largely built around the services sector. It has unique challenges with respect to its proximity to the Mexican border, and as a result, discussions about migrant workers and other things. But really, these machinations at the high end of Democratic and Republican politics are, for the most part, absent in terms of discussion as to how the U.S. economy is going to perform. If this was something that was taking place in California, which, of course, is one of the most significant economic contributors to the U.S., I would have a different view. When it comes to a state like Arizona, JD, I think for the most part, it really is a pure political story rather than one that has market or economic implications.
Listen, I suspected that would be your answer. I'm simply here to ask the questions that a casual viewer might have watching and say, I don't know, are investors following what happens in Arizona? Because many of the cable networks are giving breathless coverage to it, and I understand why. I just always want to bring something back to the money
I think
involved.
you're right, JD. Yeah. Because ultimately, U.S. media treats, and I'm being a bit pejorative here, so I do hope you'll forgive me. They treat it as a team sport. In other words, it's not the Eagles versus the Commanders. It's the Republicans versus the Democrats. And it's all about wins and losses and yards gained and passing and running and tackling and all that. All of those things can be applied to the way that media tends to cover these political developments, particularly in a case like Arizona, of course, where it levers so closely to the former president's ambitions. So I can understand why people would see it and think that there would be overlay into the broader economic space. But I do believe in this case, this is one of politics with a capital P and economics with the very smallest of e's.
But of course, maybe there is more of a direct impact on investors as we still wait remarkably not nearly, a full week after the election for the dust to settle on, the House of Representatives. I mean, especially in terms of, I think, my favorite moments when I was a Capitol Hill reporter for years, Martin, the most amazing days were the days of high-profile tech CEOs showing up on Capitol Hill for must-watch committees. When you have a Zuckerberg, when you have a Dorsey, and it'll be really interesting if Republicans get the House. What names in tech, because they will, are they going to be calling forward that investors will be forced to closely watch? And then over in the Senate, if it's Democrats, what investigative efforts or priorities do they continue that might have an impact, if not directly on the broader market, at least on some of the biggest companies that help move markets? That's going to be a fascinating debate that I think will really pick up in January. I do want to move. What is this next one here? Oh, yeah, here. Okay, we got time here. We want to pop over to FTX for all the remaining time? Yeah, we have a lot to talk about there.
Always happy to talk FTX.
Of course. I want to make sure I give this one plenty of time here at the end of our show. A new bankruptcy filing showed that FTX says it could have 1 million creditors. Martin, what is the latest this morning on the FTX mess?
Well, we had that more detailed filing last night, JD, and it was a few days late. Typically, a filing of that nature will have accompanying paperwork that sort of describes what happens and tries to lay out in a bit more detail where the creditors are and where the assets might lie. But essentially, what we saw from the filing from last night was that the ultimate sort of narrative around the company collapse was linked to the management of Sam Bankman-Fried, of course, who led the company into that spectacular failure, and the fact that there is going to be a creditor list that could top 1 million. Now, the bankruptcy lawyers themselves have said, look, we're going to have to pare this list down into a top 50 creditors kind of situation and have the assets that are left to be claimed, and there might not be many, that parsed out over that group. And I think what they are saying as a result, at least in the subtext, was there isn't an anticipation of a great recovery for anybody in this situation. And again, I do find it quite astonishing that this was a firm that had a $32 billion valuation earlier this year, and now we're talking about scratching around for pennies that may satisfy only a certain form of creditor to this company. So I do think that's astonishing. There's a Wall Street Journal story this morning that claims that Sam Bankman-Fried is out now trying to raise capital in some way, shape, or form. It obviously isn't going to be fed into FTX in any way, shape, or form. But the fact that he remains active and vocal and is tweeting things and talking to newspapers and allegedly extending activity in the investment space is absolutely astonishing to me. When inside that bankruptcy filing, JD, we also understand that bankruptcy lawyers have had to field questions from what they described as dozens of authorities around the world: the Department of Justice, the Securities and Exchange Commission, the Manhattan District Attorney's Office, to name just a few. People are circling around this company because they understand you don't just incinerate billions of dollars and then walk away and hope for the best. And I don't understand why it is that this message seems to go over the head of an otherwise extremely intelligent young man. He is facing significant allegations with respect to the collapse of this company, and he's making jokes on Twitter, allegedly playing video games to relax. And if you believe the Wall Street Journal, and there's no reason that we shouldn't, he's out there trying to raise more money. It's astonishing that this story is developing the way that it is.
I mean, plus I'd have to imagine the new Congress come January will have more than a few questions for Mr. Bankman-Fried, regardless of which party is in control. What more should we be looking for as it pertains to investigative pressures on the FTX, including groups, like you said, the SEC, the U.S. Attorney's Office, and the Commodity Futures Trading Commission?
For me, JD, the pivotal focus of this is going to be to what degree, if any, client funds were used to prop up other aspects of the business. In other words, people that had left their deposits on the crypto exchange, were they taken and transferred to other parts of the FTX operations, the Alameda Research, the hedge fund, or anything else, in order to sort of expand their activities or plug losses against bad bets that those divisions made? There's very little suggestion right now that we know the truth about this, but the fact that all of these other divisions were so deeply in the red suggests that client money was indeed directed in that way. Was it done accidentally? Was it done with permission, or was it done fraudulently? I think that's ultimately where the investigators are going to lie.
Some have argued that during the dot-com bubble burst, Martin, a lot of early internet companies failed. Yet today, the internet itself has still never been stronger. I wonder to what degree we could still possibly apply the same logic to the blockchain or even cryptocurrencies and separate those technologies and potential future opportunities, separate them from the FTXs of the world. Are people looking at this story for the first time from the outside in going to be able to do that, you think?
That's a great question, JD. Here's what I would say. When we began to see the economy expand as a result of the potential of the internet and internet companies and tech companies writ large, we at least understood the utility they could bring to the table. In other words, you could create a website that would allow you to buy and sell things more easily than you could if you had to get up out of your chair and walk to the store. That's the easiest way I can put it. Banks saw the ability to increase the activity of their customer flows as a result of putting up web portals and things like that. I'm speaking in sort of 2000 and 2001 language. At present, JD, we don't have any utility for these tokens apart from buying and selling these tokens. I know that I've said this before, but I think it bears repeating. Bitcoin does absolutely nothing that is already in the marketplace. And in fact, what is already in the marketplace does it more quickly, it does it more efficiently, it does it more cheaply, and it does it with less of a carbon footprint. Bitcoin is a problem, is a solution in search of a problem. And that problem simply doesn't exist. And that's why I simply don't think that we are going to see some kind of great expansion of utility in the cryptocurrency market, because they don't do anything apart from trade with one another. This is very different to the internet bubble of 2000, when you're right, there was hubris in terms of the valuations of many of the stocks. But at the end of the day, we understood what those companies could bring to the table economically and from the business and transactional point of view. No one has explained to me with any great efficiency how we are going to take the Bitcoin and cryptocurrency complex and make our lives better going forward.
Bitcoin is a solution in search of a problem. Put it on a bumper sticker. I really, really like that a lot, especially for a bit of needed context on a story like this. Let's move on to our rapid fire section with the remaining minutes that we have in this morning's show. Up first, have we gone through this whole show without mentioning Elon Musk's name? I believe we have.
Amazing.
That's a first, but now it's time to go there. Number one, is Tesla taking a backseat to Elon Musk's other, newer, maybe flashier ventures?
It's the shiny tinsel, isn't it? You're absolutely right. Adam Jonas is a very well-respected analyst at Morgan Stanley, and he is not a Tesla hater. He has a $330 price target on the stock, and he has an overweight rating on it at the same time. But he published a note this morning essentially saying that some of these distractions, particularly as they apply to Twitter and his ability or the energy that is going to be required to bring advertisers to the platform whilst moderating content at the same time, are going to have a negative impact in terms of sentiment on Tesla stock. Tesla stock as well, of course, is going to suffer the blunt of fading demand in China. We had retail sales data today that indicated the first decline there in more than 2 years. That economy is doing poorly, and it's an important inflection point for Tesla's expansion story. So Adam Jonas is essentially saying there's a chance this stock could get down to $150 by the end of the year. That's a 20% drawdown from where we are now. And again, this matches against his longer-term target of $330 a share. So it's somebody that we should listen to, and it's another addition to the voices that say Mr. Musk may have bitten off a bit more than he can chew at this point.
Number two, why is Warren Buffett betting big on Taiwan Semiconductor? That company has the 12th largest market cap in the world right now. What do we know here?
I love this story, JD. It's a company that's so important, but doesn't really get the kind of attention I think it might deserve in Western markets, and particularly here in the United States. TSMC, Taiwan Semiconductor, is the biggest contract chip manufacturer in the world. Essentially, they are one of the key and most important suppliers in the Apple supply chain. And they, of course, make chips or fabricate chips for handset makers and electronics makers and all sorts of other companies around the world. Their earnings reports are in tight focus each and every quarter with respect to what they see in terms of end demand, what they see in cost, and what they plan to spend in terms of their capital projects. So it's a company that has an immensely elevated presence in semiconductor and tech markets, but really doesn't get the attention I think it deserves. Warren Buffett, it certainly seems, has caught its attention. He now has a $4.1 billion stake in the company, and that was revealed in Securities and Exchange Commission filings last night. Stock is up about 12% that I saw this morning, and it's just an interesting way in which he can lever his bet on Apple, which is one of his favorite stocks, to the company that sits so tightly in its supply chain.
Yeah, absolutely. It's up 13% at the moment, and with a market cap of just north of 427 billion. Like I said, it's 12th in the world. For a bit of context, between Visa and Nvidia, two other names that our viewers will be much more familiar with. So I do appreciate the context there. Third and finally, today's the day, maybe kind of, I don't know, we'll see. November 15th, Donald Trump set to make a big announcement today. Is it going to be huge? Is it going to be what we think it is, Martin?
I honestly don't know. I'm astonished, JD, at the voices that have emerged in the past few days suggesting that the president not fulfill his ambitions to run again in 2024, given the fact that Republican candidates that he backed performed so poorly in last week's elections. Now, the former president, isn't somebody that listens to outside voices to any great degree, and he's probably going to ride his own horse, irrespective of what they have to say. But what's interesting now, at least from my perspective, JD, and it's further on down the line for sure, is if he is defeated in a Republican primary. Let's say that this evening he announces he's going to run, and let's say Ron DeSantis challenges him in a Republican primary and wins. Would you bet against the former president running as an independent candidate? And I say that because I think it's always important to remember that Bill Clinton would not have won in 1992 had Ross Perot not run as an independent and siphoned votes away from Bush Sr. and as the Republican candidate. You could have a similar ticket split in 2024 if Trump were to continue on his presidential ambitions against the wishes of the Republican Party. So what he says tonight, I think, is going to be a very important step towards that. And I think that's probably why, aside from the theater that his public statements generally tend to be, that's one of the most interesting aspects of it, at least for me.
Yeah, and a lot of historians would say Woodrow Wilson would not have won the presidential election had Teddy Roosevelt not decided to say, hey, you know what, I'm done with the grand old party. I'm going to create my own thing, go off, siphon off a ton of the votes. And as great a president as Teddy was while he was president, it's a third-party challenge. Getting into the White House is, it doesn't prove to be successful other than to do exactly that, right? Take the votes away from someone who otherwise would have a much better shot. Wow, what a debate and a conversation that is going to be. That might start tonight and might not finish for a very, very, very long time. Martin Baccardax, thanks for a great conversation today, my friend. Great to have you.
Thanks, JD.
That's going to do it for the Market Open here from the floor of the NYSE. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. And we will see you tomorrow.